Hey, what's going on, YouTube? Kenny here. No Mike today. He's a little bit sick, under the weather. So instead of delaying it for a third week in a row, no live 3 weeks in a row, we decided, hey, Kenny, your boy, is going to go ahead and try to make a video here. I don't know how this is going to go. We haven't done anything except for a live in a long time, but I do got a lot of charts, a lot of interesting things to look at. The biggest thing is that recession is still on the table, and I do want to talk about it. So instead of wasting any more time, let's go ahead and just get right into the charts. All right, this is the AAII indicator, which is the sentiment indicator for retail traders. The thing that you need to watch here carefully is the fact that we are kind of falling down on the bearish or the bullish trend. The bullish trend is now at 35.9%. It's not statistically significant until we hit 27%. So I'm not so worried about this. All I'm trying to show you is that, yes, even retail is becoming more bearish here for good reason. Here's an NAAIM, which is institutional investors, right? The kind of money managers, the experts, the smart money, if you will. As you can see here, we're back down to 60%. So this move to the top side where we were at, 2 weeks ago, we were talking about, hey, they're on leverage here. Contrarian move, huge contrarian move on the downside. A lot of selling pressure here. 40% of kind of the resources that were allocated towards the stock market, towards equities here, kind of just fell off. So obviously institutional investors fleeing here, and was a huge kind of move here. Do I expect kind of a median return towards 100? I don't know. We'll see. I think it's going to fight here for sure. But I think, given what we're about to see and some of the kind of data that I'm going to showcase, I think this is an appropriate place for it. So I don't know about any more selling off on SPY. I think it fights a little bit here. Maybe we go down towards the 40 in terms of how much you want to be allocated. And then that split gives you a nice little 60-40 split on the other side where you probably want to be more long bonds at this point. But, given what we do here at Redcliffe Research, kind of given how I'm trading, that's not what I'm looking at. I am looking at some aggressive plays right now, though. All right, this is like a really important chart to look at here. This is the Conference Board, which is the company that's looking at leading indicators. One of the leading indicators that they use is their like little proprietary indicator. That's in terms of leading indicators. There's not typically a ton, but when it comes to like measurable, determinable, very useful indicators, this is kind of one of them. And I definitely think that this is a serious one that we need to be looking at. And the reason is, if you look at the blue line year over year, this is where the lead is, right? And it's kind of like ahead of real GDP, or what GDP is saying, which is gray up here. But the biggest reason that I really like this one is, instead of some kind of, and most of them aren't black boxes, like for instance, the CNN fear and greed indicator, it is open, but I don't know that it's structurally sound. But the structure behind this is, it's not very far different from what I would make. It's not too complicated or not too complex, but it does have all the things that you want when you're taking a look at leading indicators, especially for the financial markets or kind of just GDP writ large. And so if you look at here, we have the S&P 500, leading credit index, 10-year bonds, average consumer expectations. You have ISM, building permits, private housing, average weekly hours for manufacturing, etc. Initial claims, unemployment insurance, et cetera, et cetera, et cetera. The point is, like, all the things that I would have put in here, they pretty much put in here, and obviously statistically significant in terms of leading. It's predictive. Predictive is never always 100% salient because it just isn't. But as far as it goes, it does look pretty sound here. And so what it's trying to tell us is right now, recession is still not off the table. And further that, if you look at kind of this predictive chart here, kind of how we looked at it, in the red just shows the recession signalings, right? And then, it falls off to a T on cue, right? And so, recession, 2000, 2008, 2001, 2008, 2019 going into 20 COVID, obviously, and it's showing recession here, okay? So what we're saying here is early days recession. How far, how broad, don't know, but we're saying recession. So if you want to kind of tactically position yourself, this would be the time to tactically position yourself. So, a little bit more kind of color on what the LEI is. It tracks the economic heading. Basically, it's fallen for 16 consecutive months since July. And the outlook remains highly uncertain. The biggest thing that I want to kind of express to you, though, is the leading index here continues to suggest that economic activity is likely to decelerate and descend into mild contraction in the months ahead. So the Conference Board Conference Board now forecasts a shallow recession, so Q4 2023 to Q4 2024. The point is, maybe not the worst recession, but definitely recession. And recession does a lot of things to the stock market, and it puts a lot of pressure on the stock market, even if it's a mild recession. And, as far as forecasting and trying to figure out deterministically where we were at in terms of recession, I think this was one of the ones where everybody was saying like, hey, this is kind of the most predicted recession in history. And then people were like, hey, maybe recession's off the table. Maybe we're going to have a soft landing. All these indicators suggest that recession is still in play here, is what I would say. And then just looking at jobless claims, this is kind of like, in reference to and based on relative previous years, we're extremely weak. And, this is kind of not saying much because it's standing alone. But if you put it against like each and every other year, this is kind of like what it looks like in chart. But the point I'm trying to make is seasonally, if you look at like in mass seasonally, like this slope goes down, right? And then seasonally, we get more jobs back down here, and then we go for more unemployment back into week 49, back to the end tail of the year. But the point is, right now, this blue plot, scatter plot or plot dot right here, you can see it's actually going up, which is like contrarian to what every other time has happened. And how far does it go up? Don't know. But the point is, right now, seasonally adjusted, it should be tapering down or tailoring down like this, and it's just not. So we got a problem here too as well. The one thing that I will say is small business is continuing to hire. You can sit here and stare at these charts all you want, but the biggest chart that I do want to look at in terms of just kind of due diligence is just realizing and unpacking how much of small business is 0 to 49 employees. That's ridiculous. 44% of U.S. is now employed by small businesses, 49%. So of the Googles, of all those Amazons, of all those huge, humongous companies we cede power to, they only employ 16.4%. So if you're like, oh man, but they give us jobs, probably not. And by the way, they give jobs to all those like, C-suite directors, those suite level, high paying jobs that, gosh, if you got one, good for you. Point is, small business really strong right now. I don't know how long they can hold on, but in terms of GDP growth, GDP contribution, it's all small business right now. Not all, but relatively speaking, a lot of large business right now is like kind of stalling out, where small business is still kind of growing and leading the way, GDP wise. So we got to talk about Bitcoin because this is like the kind of risk on asset that we use, and it usually gives us an early kind of warning sign when it comes to like selling other stuff off, if you will. So it's like, once Bitcoin starts collapsing, and then all the other risk on assets kind of go off. I was calling for like a head and shoulder. This is an old chart, but like old chart meaning I pulled it and I didn't take all the indicators off that I was using. But I was calling for a head and shoulders right here. I was really hoping for it to go down, do this and do this, right? Get us back to 16,000. Little late. I don't know if you can consider this a double top. Really, it's more of a double top than a shoulder. But giving us this definite down point, can this be the floor here? Maybe, but as we well know, risky assets like this, as durable as Bitcoin has been, we still haven't seen a use case. That's kind of my theory, my thesis. I'm sure there's crypto bulls out there still. God bless you for hanging in there. But I just think that right now we're headed for the bottom. I'm not adding to anything when it comes to crypto. I mean, I'm holding what I got, but I'm not adding to anything. Matter of fact, I don't hate it if you wanted to sell all your cryptocurrency here. I do feel like there's going to be a bottoming out and reckoning at hand still. I mean, $16,000 Bitcoin, I don't even think that's, out of play. I really think that honestly 10,000, 7, 8, 9,000 could be in play depending how bad this recession is. And it looks like it's going to be mild. But again, the thing about this is if you think like it's going to kind of resubstantiate or reconstitute, like I just don't see it. Like I just don't see where that can happen because of just, look, there's just no use case. There's just no use case. And AI is getting real hot right now. And I think that's like the next trend. So I don't see this surviving that. And if you want to look at kind of performance, this is just 5-day for the leaders, leaders quote unquote, because the leader is only lost 6.25% as Bitcoin Gold for whatever reason. Monero, whatever. Here's Neo in negative 17.47%. Crazy, but like Litecoin taking a dive, 22% down, XRP 20% down. And obviously here's Bitcoin itself. Bitcoin proper took 11% dive in 5 days, which, maybe not substantial for Bitcoin, but hey, you keep taking 11% dives, you're going to hit the floor real fast. So just something to be aware of. And obviously we use that for a proxy for risk on assets. And here's the Russell 2000. So IWM, which is small cap, right? Small cap ranging up to, I don't know, whatever billion, I think 10 billion for small cap, right? But the point is, we took an 8% nosedive here on small cap. So not insubstantial. So Bitcoin 11%, this is 8.2%, a lot more to come, I think. And I think, if we look at 164 here for IWM, there's definitely a floor. I mean, we're bouncing. Definitely a floor here. I still think there's going to be a fight here, right? But, looks like could be a nice little head and shoulders here would be proper. And then we hit the support floor right here. And I think the reason I'm showing you this is because risk on assets, I think they're going to cool down a lot faster than the big mega cap names. Just a revisit on BAH, we said a long time ago, I just want to just kind of point this out really quickly. Like when you're talking about trades like this, yes, we had to be patient. It just took time. But in 2021, called out BAH because everybody was like Palantir. I was like, Palantir's trash. It's doing pretty well right now and actually made some pivots. But I was like, Palantir's trash. Goes to $6, right? And check. I was right about that. Whatever. Just, like a lot of people haven't even used it and didn't do correct due diligence. I wouldn't expect most people to be able to use it or even kind of audit the team. But, I was fortunate enough to have, some insight into how it works, what it's used for, and kind of like the biggest contracts it was maintaining. Point is, I didn't just say don't do anything. I said, okay, while BAH is consultant heavy, they are working on frameworks, and they had the Advana platform, which DoD was adopting at the time. I don't know where that is right now. I haven't been following the memoranda. But the point is BAH was doing really well for themselves when it comes to DoD contracting and their kind of growth cycle. Point is, if you bought here when I was talking about it and saying, hey, what's the alternative? You had a 62.71% uptick where Palantir nosedived like 85% or something like that. The point is, there's good companies out there. You just have to unpack all the noise and kind of take a look at what you're looking at. So if you still want to get in here, I don't know that this is a great place because I think everything is selling off. But my point is, hell, you're at the point right now that you could probably sell BAH. But in terms of market cap and market cap spend, again, very consult heavy, but the margins are still there right now. And look, if we start fucking putting money towards UAP research and development, hey, maybe BAH gets some more funding or whatever. But yeah, the whole data structure is being built on the Advana platform, which BAH owns, which, hey man, for Department of Defense, that's literally all the AI spending is going towards that, basically, right? All the chief data officers, chief data executives are working towards that platform. Well, they're supposed to be. I know there's workarounds. I know there's people playing around, and there's always politics and people trying to subvert that. But as a consolidated platform, that's supposed to be the platform. All right, Ford is doing exactly what we thought. We said, hey, when they break out here, that's your breakout. But I think it's done. Based on the news we have from Ford, we're saying that, hey, there's no good news here. There's no reason for it not to sell off. Sells off completely. We're looking at Ford going down to $11. I don't see a fight here. In fact, if it hits that floor, you might get a quick little bounce just because the algos are going to try to trade that huge bounce because, we've hit this floor like 1, 2, 3, 4, 5. This will be 6, right? Point is, if it hits here, can you get some money on a little bounce? Yeah, but I'm just not really optimistic about Ford. I'm staying away, but my whole point was I'm not on the long side either. All right, so what trades do I like? Well, I always like betting against Kathy, and this has become an ongoing joke at this point. But the point of the matter is ARK only ever does well in times of excess returns and times of certainty or times of hyper speculation, right? So, and you say, oh, the pandemic was not good. No, it was a good time because there was an influx of money that was moving all the stocks up, highly speculative names that people didn't have money to put into before. And now, everything kind of is circling, the wagons are circling. The point is, we're sitting here at $40.38 here, right? And I think if we're looking at a shoulder here, if it fights back up, we can fight back up to $44.88 right here, right? And then from there, and I'm showing you this blue line, from there, you can have a 32% decline here very, very easily, especially if you're looking from now into Q1. That gives you about let's just say 5, 6, 7 months of kind of premium. So if you buy some leaps right here, like at least, 6 months isn't technically a leap, but like it's long-term enough. If you bought 6-month contracts on ARC here, or even, 3 months is aggressive, but I'm not beyond it. But if you buy some contracts here, given it 6 months, like I think it will fall and will fail down to 30. There's a couple of reasons for that, but like number one, like you're already betting against like all the small cap names which she owns, right? Like she sells Nvidia at the bottom, she buys, you get the point. You get the point. If you've been watching this channel, you get the point. The other point is like it's compounding inefficiencies is what I like to call it, right? Compounding mistakes. So like the companies are not executing well, the companies that she's investing in, and then her trading execution is bad too. So like there's a multiplier here, which is why I like to pick on her. So like if she's doing stuff wrong and they're doing stuff wrong, there's no mitigation. And we know her risk officers are non-existent. They're just there to be there. That's not a thing. Like they have way too much risk on, period. And so fact of the matter is like if I'm going to short a liquid name, ARK-K comes to mind for sure. And yeah, it sounds like I'm picking on them, but hey, it's a fair trade here when it comes to that. Disney is an interesting one because it fell back down to the bottom of the floor here. We're looking at 85.96. The one thing that I'll say about Disney is like it's really IP heavy driven stock, and if you look at kind of its rise to prominence here and here, it's like the funny thing is it's like at this point like they're not making any more theme parks. Theme parks do very well for themselves and they're healthy, but I don't see a lot of growth there. Like population decline all across the world except for like India, right? Proper. So I don't know what that looks like. The thing that I do know that looks like, this is like good ass movies here, good movies, right? And then pandemic here, people can't go to the theaters and people can't go to Disneyland. And then here's some more good movies. And now here's like, I don't know, I hate to say this, but go woke, go broke, whatever. Like bad movies, like, creatively bankrupt. Hey, they still got a ton of IPs that they can play with, but I think right here, and we know they have, because, like think about Star Wars, how many movies you were getting. Like you were getting some movies, and then all of a sudden you got all this stuff, and they're like, hey, how much can these people actually consume? Well, we've hit the limit. We know how much we can consume, and there is a threshold. And so what I'm suggesting is I don't know that they can abuse their IPs much longer. My point is it's on the floor, and it seems like a really good buy, but it's not without risk. It's not without risk because if they drive these IPs down to the floor, you can still get back into like, the 1990 levels where, Disney is all right, but they're not like a huge conglomerate just eating up everything, So, there's that. And then, there's a lot of, people just kind of on the sidelines here, but I'm not really happy with the buy here, but I don't hate it. I don't hate it. It's a gamble either way. I'm just suggesting it's not without risk. This is not like a blind buy at this point because this company is doing really bad things, like in terms of like the movies are not good, which is like huge kind of staple to their bottom line. And then I want to talk about 5 and below here because, I don't really know much about it except for my daughters, like my teenage daughters, and they always just want to go. They just want to go for fun. I think the thing about 5 and below is it sells things at like $5-ish, right? $5-ish. And the point is, you can take $20, especially during a recession. You take $20 and go enjoy yourself. Go buy like 4 things or whatever like that. But I think consumer in terms of not just my teenage kids, but I see obviously adults there and everything like that, or they take their kids there and be like, hey, go ahead and buy a couple of things. And it feels nice to be able to buy a couple of things instead of being priced out of everything. And it's not quite the dollar store, so there's a little bit more quality. Like I'm saying that really loosely here. But I've been watching this for a while. But what I'm seeing here is an inverse Head and Shoulders. And again, the reason why 5 and below skyrocketed before was because of recession stuff. Because, when consumer is not strong, weren't able to really put together a case to make for in terms of being able to spend money on things. But this is one of those ones where like, you still might buy cosmetics. They still might buy a lipstick because, it's your like creature comfort, your like final thing that you're never going to give up. But shopping, if you don't want to give up on shopping, you might go shop at 5 and below. So I'm seeing an inverse head and shoulders, and you see a huge volume profile here. So there's definitely a reason to be, if you're ever going to go long anything, and like money's hiding here. Let me show you kind of just the breakdown. Like PE is super rich. So I know that's going to sell off very soon. It's got to, right? But here's the thing. Revenue skyrocketing to the upside. So that's just a check mark. This is like the only X really. If we look at gross profit margin, this is super, super good. 35% for a retail facing, consumer facing brand. I mean, they must be getting some real good deals. Leverage free cash flow, whatever, that's fine. Gross profits are there. Shares outstanding, they're actually buying back shares. It's kind of trending to the downside. Current ratio here, 1.8, which is perfect. The market cap is 10 bill, and this is a big important reason. It's 10.8, right? So one of the things that you need to identify, or you should know if you're kind of trading the stock market, like mid cap is anywhere from like 2 bill to 10 bill, right? Once we get to 10 bill, the next move is 10 bill to 100 billion, which becomes large cap, right? This is large cap. So my point is to get to large cap status, from mid cap to large cap status, that is the biggest, most profitable by the stats, by the statistics that we track and other folks have tracked through time. The move from mid cap to large cap is generally always the most profitable. It's always the one that like nobody believes is going to happen, because look at this, 40 PE, right? But that can easily get higher, and then the money can come in and they actually draw profits, and then the PE gets compressed, not because of any kind of like shenanigans, but because they're just generally more profitable. The point is, the move to mid cap to large cap is something that's quite a premium, and it's kind of the companies that I look for. And this checks the block when it comes to that. Forward PE is kind of decreasing, which means, yes, generating forward revenues should be better, which is compressing the PE ratio even more. So that's what you kind of want to see. You don't want to see a higher forward PE. And price to book is extremely high. But my point is, this is a brand that's taking kind of a recession-proof shopping experience and putting it together for consumer. And that's kind of where I'm at. All right, so that's what I'm looking at for this week. Let me know in the comments what you think or what you're looking at. Sorry we didn't do a live. I love the live much more than this. Love interacting and chatting with y'all. But I do want to do more videos, but it's been a real busy summer, but hopefully things slow down and unpack. But definitely got to get these lives back in, boys and girls. Going to get them in. Let me know what you're looking at, what you're trading, what you're thinking. Is anybody long out there? Because if you're long, let me know, because I want to know what you're long. Like the only long I could find there is 5 and below. Only because last time we went to recession and everything sold off, that was a good place for folks to hide. I'm kind of eyeballing it now as a place to hide as well. Anyways, thanks for watching, and we'll see you soon. Thanks, everybody. Bye.